You work hard for every dollar you earn, and it's my mission to help you keep more of it. But just keeping it isn't enough. If you want to build real, long-term financial security, your money needs to work just as hard as you do. This is the whole idea behind investing. It's not about getting rich quick or gambling on some hot tip. It's about putting your money to work in a smart, steady way so that it can grow over time. Think of it like planting a tree. You start with a small seed, but with time, water, and sunlight, it can grow into something large and strong that provides shade for years to come. Investing is simply the process of using your money to buy something that you believe will be worth more in the future. This something is called an asset. When you leave your money sitting in a checking account, it's not really doing anything. In fact, it's slowly losing its buying power because of something called inflation. Inflation is just a fancy word for the slow and steady increase in the price of everything, from groceries to gasoline. If prices go up by 3% in a year, and your money earns nothing, you've effectively lost 3% of your spending power. Investing is your best defense against this silent erosion of your wealth. It gives your money a chance to grow faster than inflation, helping you build a more secure future. Many people hear the word investing and immediately think it's too complicated or too risky for them. They picture fast-talking people on Wall Street and charts with confusing squiggly lines. I want you to push that image out of your mind. For most of us, smart investing is simple, and dare I say, a little boring. And that's a good thing. It's about making a plan, sticking to it, and letting time do the heavy lifting. It's about creating a future where you are in control, whether that means retiring comfortably, paying for a child's education, or simply having a strong financial safety net. Your financial future is too important to leave to chance, and putting your money to work is the most powerful step you can take. So, what does it mean for your money to have a job? It means your dollars are out there, earning more dollars for you, even while you sleep. Imagine you have $100. If you put it to work in an investment that earns a 7% return for the year, at the end of the year, you'll have $107. That extra $7 might not seem like much, but the next year you're earning a return on $107, not just the original 100. When we talk about putting your money to work, the absolute first step for everyone is a savings account. I know what you might be thinking. A savings account isn't a high-powered investment. And you're right, it's not. But it's the foundation for all your other financial goals. Specifically, I'm talking about a high-yield savings account, often offered by online banks. As of today, August 19, 2025, many offer rates much higher than traditional banks. This is where you build your emergency fund. Money for life's unexpected curveballs, a car repair, a medical bill. Its job, be safe and accessible. You need to get that money quickly without worrying about the stock market. A high-yield savings account is perfect. Money is insured by the government, up to $250,000 per depositor per insured bank, so your principal risk is virtually zero. While interest may not beat inflation every year, it outperforms traditional savings or checking accounts that pay almost nothing. Think of it as the defensive line on your financial team, protecting you from disaster. Example: you have $5,000 for an emergency fund. In a checking account that pays no interest, after a year, you still have $5,000. In a high-yield savings account at 4.5%, you'd have $5,225. That's an extra $225. It's free money with almost no effort. Once your emergency fund is secure, it's time to think about growing your money for the long term. This is where stocks come into play. Buying a stock, also called a share or equity, means you're buying a tiny piece of ownership in a public company. Visual a pie chart with one slice pulled out representing a single share of a company. Example: Apple. Example: Coca-Cola. You become a part owner of that business. When the company does well and makes a profit, the value of your slice can go up. If the company struggles, the value can go down. That direct link to a business's fortunes gives stocks potential for high growth. The reward, potentially significant long-term growth. Historically, the stock market has averaged about 10% annually over long periods. That's much higher than savings accounts. That's also higher than bonds. That growth helps your money outpace inflation and build real wealth over decades. For long-term goals like retirement, 20 years, 30 years, 40 years stocks are essential. But with greater reward comes greater risk. Stocks can be volatile, up and down, sometimes dramatically. A company could report poor earnings. A new competitor could emerge. The entire economy could hit a rough patch. In the short term, the market is unpredictable. Don't invest money in stocks you'll need in the next 5 years. Investing in stocks requires a long-term mindset and emotional discipline. Don't panic sell during temporary declines. For beginners, don't try picking individual winners. Even professionals get it wrong. Instead, invest in low-cost index funds or exchange-traded funds, ETFs. An index fund is a mutual fund that holds a basket of stocks to mimic a market index like the S&P 500. If stocks are the engine of your investment portfolio designed for growth, then bonds are the brakes designed for stability. When you buy a bond, you are essentially lending money to an entity, a corporation, a government like the U.S. Treasury. In return for your loan, the issuer promises to pay you periodic interest payments over a set term. At the end of that term, known as the bond's maturity, the issuer repays your original investment, the principal, in full. Another major category of investment many people consider is real estate. This typically means buying physical property, such as a house, an apartment building, a piece of land, with the expectation that its value will increase over time. For most Americans, their primary residence is actually their largest investment. Beyond that, people invest in real estate by buying rental properties. The goal here is twofold: collect regular income from tenants, rent, benefit from property appreciation, market value increase. Now that we've covered the main types of investments, let's talk about the single most important principle for any investor: diversification. You have certainly heard the old saying, "Don't put all your eggs in one basket." This is the core idea of diversification. It means spreading your money across different types of investments to reduce your overall risk. The goal is to build a portfolio where some investments are doing well even when others are not. It's a strategy to smooth out the inevitable bumps and protect you from a major loss. If there is one secret weapon in the world of investing, it is time. The earlier you start investing, the more powerful your money becomes. This is because of the incredible force of compound interest. Compounding is the process of earning returns not just on your original investment, but also on the accumulated returns from previous years. Let's look at a simple, powerful example. Imagine two friends. Anna, Ben. Anna starts investing $200 a month at age 25. She does this for just 10 years and then stops, having invested a total of $24,000. Ben waits until he is 35 to start. He invests the same $200 a month. He does it for 30 years, right up until age 65. Ben invests a total of $72,000, 3 times as much as Anna. Assuming they both earn an average 8% annual return, who do you think has more money at age 65? The answer is Anna. Her initial investment, thanks to 40 years of compounding, grows to over $400,000. Ben's much larger investment, with only 30 years to grow, ends up at around $290,000. This example clearly shows that the time your money is invested is far more important than the amount you invest. This is why I urge young people to start investing as soon as they have their first job, even if it's just $25 a month, $50 a month. The habit is more important than the amount in the beginning. Delaying by just a few years can mean you have to save significantly more money later in life to catch up. The cost of waiting is immense, and it's a price you don't have to pay. Getting started with investing can feel overwhelming, but I promise you it can be broken down into a few simple, manageable steps. The first concrete step, as we've discussed, is to build your emergency fund. Open a high-yield savings account online. It only takes a few minutes. Once your emergency fund is established, your next step is to open a retirement investment account. For most people, the best place to start is with a workplace retirement plan like a 401k or 403(b), especially if your employer offers a matching contribution. An employer match is free money. Now, what should you invest in within that 401k or IRA? Keep it simple. Look for a low-cost target date index fund. The final step is to make it automatic and then leave it alone. Set up your contributions to be automatically deducted from your paycheck or bank account each month. Once it's set up, your job is to resist the urge to constantly check your balance or react to scary news headlines. Long-term investing is like growing a forest, not a garden. You plant the seeds and then let them grow for decades with minimal interference. As we wrap up our 10-minute crash course, let's summarize the smartest moves you can make today, on August 19, 2025, to secure your financial future. It's not about finding a secret formula or timing the market perfectly. It's about following a few timeless, proven principles with consistency and discipline. Your financial journey is a marathon, not a sprint, and these steps will put you on the right path. First, pay yourself first by building and maintaining your emergency fund in a high-yield savings account. This is your shield. It protects your long-term investments and your peace of mind from life's inevitable surprises. Second, take full advantage of tax-advantaged retirement accounts like a 401k Roth IRA. Always contribute enough to get any employer match offered. It is the best return on investment you will ever find. Third, when you invest, keep it simple, low-cost, and diversified. For the vast majority of people, a portfolio built on broad market, low-cost index funds, a single target date fund is the most effective strategy. Finally, and most importantly, trust in the power of time and consistency. Start now. Automate your contributions. Commit to your plan for the long haul. By following these simple, trustworthy steps, you are not just investing money, you are investing in a future where you have control, security, and the freedom to live life on your own terms. That is the smartest investment move anyone can make. If you want to build your wealth, check out the 2 recommended videos on your screen now.